study with me. Come and study with me. Yeah, late nights, clean notes. I want the whole load. Gold pen on the page. Big dream, small cage. Put some credential behind your name. Walk in that room and own the frame. This is your time, your season to grow. One step at a time, watch your future glow. Yes, you can do it, yes you can. Rise from the doubt and make your stand. From high school diploma to EA, CPA, DBA, I see the fire, I hear you say, come study with me, come study with me. Come and study with me, come and study with me, come and study with me. Put your name on top, put your name on top. This is your season, this is your season. Yeah. Library cards, fresh highlighters, head down focus, future fighters. One more chapter, one more try, one more test, one more why. From high school diploma to EA, CPA, DBA, that's the climb, that's the way. This is my goal, what is yours? Open that door, unlock more. Yes, you can do it, yes you can. No more fear, just make the plan. Put some credential behind your name. Move with purpose, play that game. Come study with me, come study with me. Come and study with me, come and study with me, come and study with me. Put your name on top, put your name on top. This is your season.
This is your season.
This is your season.
All right, so we are back. We are back to our study session. Earlier, it was, man, I was so sleepy, so tired that I had to close the live. I had to go take some rest because sometimes your body needs some rest. You can keep pushing, but sometimes your body's gonna tell you it's time to stop for a minute to take some rest so you can recover and then get back in the game. So that's what I had to do because I was here sitting down trying to study, but I was really sleeping. So now we are back. If you're ready, let's go ahead and get your book, your notebook, your pen, your pencils, whatever you use to study, your computer. Let's go ahead and enter a deep focus session so that we can master something. All right, so I'm currently studying for the CPA exam for the FAR. So no matter what you're studying for, we can study together, okay? So let's go ahead and make it happen, all right? I'll talk to you in about an hour. common stock, 100,000, $22 per share. So if it was issued $22 per share, additional paid-in capital increased 120,000 because the par value was $10, but the sell price is $22. Okay. Additional paid-in capital increase 120,000. Equipment. Equipment is investing. This is notes payable increase 100. Common stock increase $100,000. So that's gonna be $220,000. Okay, additional paid-in capital. That's money you receive. That's money received. So I'm gonna say 220. Let's make minus 110 minus 160 minus 110 minus 160. That's negative 50,000. Dividend payable. But no, how much dividend you paid? 340. You paid dividend $340,000. Dividend paid $340,000. So here you have 220,000 minus notes payable 110 minus 340,000. So that's negative 131. You're still not 110. Still not telling me what's going on. To understand that. step 4, net cash used in financing activity. Okay, negative 120. So the 110 threw me off. So the 100 notes payable increase. Notes payable increase. This is not cash. It's notes payable. You already know it's notes payable. It's not cash. So 220 minus 340. 120. I think I'm gonna number it wrong so that I can come back to it. If I remember it. Which of the following is not a characteristic of consolidated financial statement prepared following an operating period that occurred after the date of business combination? After the date of business combination, after combination. Which of the following is not a characteristic of consolidated financial statement? Not a characteristic of consolidated financial statement. Which one is not a characteristic of consolidated financial statement? Which one is of the following is not a characteristic of consolidated financial statements prepared following an operating period that occurred after the date of business combination? After the date of the business combination, a full set of consolidated financial statement will be required. That's correct. The method used by the parent to carry on its books, its investment in the subsidiary will affect the consolidated process. Yes, it will affect the consolidated process. Intercompany transactions may have occurred since the business combination. That's correct. The method used by the parent to carry on its books, its investment in the subsidiary will affect the final consolidated financial statements. It will not affect the final consolidated financial statement. It will affect the consolidating process, but not the final consolidated financial statement. And let's see. That's correct. This is correct. During year 1, okay? During year 1, there is a lot of rain around here in Georgia today. It's been raining the whole day. So it's a good time to be locked in and study, okay? If you're in Georgia, it's a good time to be locked in and study. So I just wanted to let you know that. During year 1, Part Corp sold goods to its 80% owned subsidiary, Seed Corp, at December 31st, year 1. One half of these goods were included in Seed's ending inventory. Year 1 selling expenses were $1,100,000 for Part and $400,000 for Seed. Part selling expenses included $50,000 in freight out cost for goods sold to Seed. Part did not charge Seed for these costs. What amount of selling expenses should be reported in Part's year 1 consolidated statements? During year 1, Part Corp sold goods to its 80% owned subsidiary. This is consolidated entity. At December 31st, year one half of these goods were included in seeds ending inventory. So one half was sold. Alright, year one selling expenses were 1.1 million for part and 400,000 for seed. Parts selling expenses included $50,000 in freight out cost for goods sold to seed. Okay. So in the consolidation, what amount of selling expense should be reported in parts year one consolidated income statement? Remove the $50,000, which is internal transaction. Goods were included in one half of the goods. Year one selling expense were 1.1 million for part and 400,000 for seed. What amount of selling expense? Well, combined expenses is 1.1 million plus 400,000. That's 1.5 million. But one thing is, the $50,000 was also reported on the statement of part. So we're gonna remove the 50,000 from the 1.1 million. So instead of being 1,500,000, it's gonna be 1,450,000. Correcto. That's very important to understand. Which of the following must be eliminated as a part of the consolidation process? Which of the following must be eliminated as part of the consolidation process? Intercompany accounts receivable, intercompany sales revenue. Eliminated. Accounts receivable, intercompany accounts receivable, intercompany sales revenue. Well, both will be eliminated. If it's intercompany, that means it's internal transaction, right? Intercompany internal transaction in the consolidation will be eliminated. So both of them. Correcto. That's correct. AY Corp owns 100% of B Corp and C Corp. B sells merchandise exclusively to C, and C sells exclusively to external customers. AY is a holding company with no income of its own. B and C have the following information for year one. Sales: B Corp 130,000, C Corp 91,000. Cost of sales: 100,000, C Corp 65,000. Beginning inventory 0, ending inventory 0, but here 65,000. What amount should be reported as gross profit in the consolidated income statement for the year ended December 31st, year one? What amount Cost of sales 100,000. So B, AY Corp owns 100% of B Corp, E Corp, and C Corp. Okay, so they're family. B sells merchandise exclusive to C. So sales of B, the $130,000, is internal transaction to C. C has sales of $91,000 to external clients. AY is a holding company with no income of its own. B and C have the following information. So now, the $130,000 from B to C is eliminated because that's internal transaction. But now, C Corp had sales of $91,000. So that means from the $130,000, we have $91,000. That is real cost. Cost of sales. Real sales. Cost of sales 100,000. Cost of sales for C is 65,000. Ending inventory $65,000. Cost of sales 100,000. Cost of sales 65,000. So question is asking me gross profit. Gross profit. Cost of sales 65, ending inventory 65. 65 plus 60 65 plus 65. That's 130. 65 times 2 is 130. So, okay. You have cost of sales 65,000. Ending inventory 65,000. Sales is 130,000. Okay. Some explanation for this. Okay, think about the consolidation from the perspective of the outside world. B sells only to C, so B sales are entirely intercompany sales and must be eliminated. That's right, 130,000. Eliminate B's internal sales. $130,000. B cost of sales 100,000. These are internal, so remove 130,000. Cost of goods 100,000. Internal profit 130 minus 100,000 is 30,000. That's $30,000 is unrealized unless inventory was sold outside. Step 2, look at C sales to outside. C sells 91,000. That says in consolidated sales. This stays in consolidated sales. A is the determine consolidated cost of sales. C beginning inventory is 0. Purchase from B is 130,000. Ending So C's cost of sales is 0 plus 130 minus 65 equals 65. But C reported cost of sales already as 65,000, which means half of the inventory was sold externally, half remains unsold. Unrealized profit in ending inventory. B's markup 130,000 minus $130,000. Profit rate on transfer 30,000. Ending inventory 65. Unrealized profit 65. 15,000. This must be eliminated. Consolidated gross profit external sales 91,000. Consolidated cost of sales C reported 65,000. And unrealized profit elimination 65,000 plus 15. 80,000 gross profit 91,000 minus 80,000. This I want it wrong, so I can come back to it because that's not even right. 'Statements if a company fails to eliminate intercompany sales at a profit against intercompany purchases. If you fail to eliminate intercompany sales at a profit against intercompany purchases, consolidated assets will be overstated. Consolidated net income will be overstated because you will report more money than you actually have, because you will be reporting intercompany transactions. You will be reporting intercompany profits. So assets. Company fails to eliminate intercompany sales at a profit against intercompany purchases. Asset will be overstated. You will, as part of the consolidation process, transactions between companies in the consolidated group, known as intercompany transactions, are eliminated because they have the potential to distort overall financial statement results. Sales of goods between subsidiary parents and parent are reported on the parent and subsidiary companies' individual financial statement. Sales of inventory increase gross profit. Sales of inventory increase gross profit. artificially overstate consolidated net income and inventory, which is asset. Okay, I think we gotta take some notes. And there's passbook, gotta take some notes. Things to remember: one consolidated financial statement, transaction between companies in the consolidated group, known as intercompany transactions, are eliminated during the consolidation process, not eliminating company sales of inventory artificially. Eliminating intercompany sales of inventory. Not eliminating intercompany sales. Artificial. Artificially overstates. Overstate consolidated net income and inventory. Overstates. So do dollars occurred during year one. Assets 89,000, liabilities 27,000, capital stock 60,000, additional paid-in capital 6,000, except for 13,000 dividend payment and the year's earnings. There were no changes in retained earnings for year one. What was Vale's net income for year one? Net income. You have assets, you have liabilities, capital stock, additional paid-in capital. And you need to have the formula for net income. So you need to calculate. Net income. Okay. Use accounting equation asset liability plus equity. So changes must also balance. Step 1, find total increase in equity. Capital stock increase $60,000. Capital stock increase. Capital stock $60,000. Okay. Additional paid-in capital increase 6,000. Additional paid-in capital increase 6,000. Okay. So far, equity increased 66,000. But asset increased by $89,000 and liabilities increased by $27,000. Okay, so total equity increase must be $89,000 minus $27,000. That's $62,000. So okay, where did that come from? But assets increased by $89,000 and liabilities increased by $27,000. Total equity, okay, so now equity will be asset minus liabilities. That's equity, $89,000 minus liabilities $27,000. So equity is $62,000. Okay. So for retained earnings change. Total equity increase 62,000. Non-equity increase from stock. Additional paid-in capital 66,000. Therefore, retained earnings changed by 62,000 minus 66. That's 4,000. So retained earnings decreased by 4,000. Step 3, use retained earnings formula. And then this one, I need to come back to this question because I'm gonna have to do this offline myself because this has a lot to it. To get it, so I can just Bill Inc. had the following information available at the end of year 3. Accounts payable decrease, dividend payable increase, notes payable increase, common stock increase 100,000, $10 par, additional paid-in capital increase 120,000. Bill declared cash dividends of $500,000 in year 3. The common stock was issued $22 per share. Equipment costing $110,000 was acquired through issuance of long-term notes payable. In Bill's year 3, net cash used in financing activities. So we're talking about financing activities. We have first accounts payable, which is operating activity. We don't count that. So we have dividend payable. Dividends payable increased by $160,000. So we would have this on the side, $160,000. Notes payable increased by $110,000. Now I have this on the side. Common stock, par value $10 increased $100,000. But you also have additional paid-in capital. is $220,000. So let's keep reading. Bill declared cash dividend of $500,000 in year 3. So there is a declaration of dividend of $500,000, but here on the report they say that dividend payable is increased by $160,000. So when you do it, so now we need to find how much dividend was paid. So we do the 500,000 minus 160,000. That gives us the $340,000. 340. This is money outflow. That's outflow. That's money going out. All right. Notes payable increase. Here they say that equipment costing $110,000 was acquired through issuance of a long-term note payable. So there was a long-term note payable. And when we check this, it says notes payable. If it's a notes payable, it's not yet cash. It's not cash yet because it says you have not received the money. It's not paid. So that means you cannot include it. It's not cash. So here you have money that came in is $220,000. Money that went out is $340,000. So this is what you will calculate. Okay. So you have $220,000 minus $340,000. That's negative $120,000. Okay. Negative 120. That makes sense. Okay, that's fine. That's good. Milco reported pre-tax income of $152,000 for the year ended December 31st. During the year-end audit, the external auditors discovered the following errors. Ending inventory is $30,000 overstated. Depreciation expense $64,000 understated. What amount should Mill report as the correct pre-tax income for the year ending December 31st? So you overstate. Mill reported pre-tax income of 100 pre-tax income. Pre-tax, yeah, before they take taxes out, $52,500 at the year. During the year, okay. So there was a mistake. The error is that you overstated ending inventory by $30,000. Ending inventory was, so there is a $30,000 that is reported in pre-tax income. That is not income. Depreciation expense $64,000 understated. Okay. I need some help with this. Okay. Start with the reported pre-tax income, 152,500. Okay. Ending inventory, $30,000 overstated. Ending inventory affects cost of goods sold. Right? So cost of goods sold, purchases minus ending inventory. Beginning inventory plus purchases minus ending inventory. That's the formula for cost of goods sold. If ending inventory is overstated, cost of goods sold is understated. income is overstated, so subtract $30,000 from income, which is $152,500. Depreciation expense understated by 64,000. If depreciation expense was understated, expenses were too low. Yeah, income was too high. So subtract 64,000. Okay. So understand, ending inventory was overstated. It overstayed ending inventory by 30,000. So that means that $30,000 is coming from the pre-tax income that was reported. So you have to subtract this. Depreciation expense, $64,000 understated. You understand the depreciation. If depreciation expense was understated, expenses were too low. Expenses were too low. Income was too high. Yeah. Because you understated depreciation. Income was too high. Let's say you have a $100,000 income, but you have a $64,000 depreciation that you did not report. So now you will be reporting $100,000. So income will be too high. So for you to reconcile this, you need to remove the $64,000 from the income. Okay. That makes sense. Gotta take some notes. Gotta take some notes. Cost of goods sold. Cost of goods sold, beginning inventory plus purchases minus ending inventory. Cost of goods sold, beginning inventory plus purchases minus ending inventory. Cost of goods sold. Okay. Cost of goods sold. Beginning inventory plus purchases minus ending inventory. Plus purchases minus ending inventory. Beginning inventory plus purchases minus ending inventory. Cost of goods sales 100,000. Beginning and inventory 65. What amount should be reported as gross profit in the consolidated income statement for the year ended December 31st, year 1? What did we say? Cost of your sales. Sales is 130,000. Cost of sales 100,000. But these are internal transactions. Must be eliminated. 91,000. Cost of sales 65,000. So I would easily say 91 minus 65. And do that. 91 minus 65. So that gives me 26,000. It should be what it is. 26,000. But cost of sales 100,000. Cost of sales 65,000. One thing happened. Sales $130,000. Cost of sales 65. Cost of sales 100,000. And then 66, so that's 130,000. I need to get to the point where I understand that without looking anywhere else. This is the same type of consolidation problem as before. The key idea, B sales only internal, eliminate B sales, so also sales to outsiders remain removed. Okay. External sales, only C sales to outside customers 91,000. So consolidated sales is $91,000. Okay. B's profit on transfer. Sales 130,000. Cost 100,000. Okay, so you have a profit of $30,000. You have a profit of $30,000. Makes sense. Determine unrealized profit in ending inventory. Ending inventory 65,000. Since B sold inventory to C for 130,000, total, and 65,000 remains. So it's 50%. Makes sense. So half of the goods remain unsold. Therefore, half the intercompany profit is unrealized. Okay. So $30,000 profit is unrealized. No. $30,000. Wait. It's unrealized. Okay, 30,000. That's 15,000. Remove this profit. Remove the 15,000. So you have 15,000. The consolidated gross profit external sales 90,000, 91,000. True cost of the consolidated group. This reported cost of sales 65,000. And unrealized profit elimination. You can find 11,000. This is where I need to come back to. It's not even 11,000. It's not 11,000. It's 41,000. The answer is not 11,000, but the answer is 41,000. C sales to external customers total 91, and its cost of sales is 65,000, resulting in $26,000 gross profit. Gross profit 91 minus 65 is 26. Because C's ending inventory of 65,000 was purchased from B, this amount includes B's profit that has not yet been realized. Unrealized profit 65 times 23%, that's 15,000. This consolidated gross profit equals B's $30,000 plus C's 26,000 minus $15,000 in realized profit, or 41,000. 30,000 plus 26 minus 15. Okay. I'll come back to this. On January 1st, year 5, a company collected rent from a customer in the amount of $18,000 minus $8,000, $8,400 related to year 6, and $9,600 related to year 7. The company incorrectly recorded the total amount collected as rental revenue in year 5. What is the effect of this error on retained earnings at December 31st, year 6? Retained earnings will be overstated because in January year 5, company collected rent from a customer in the amount of $18,000 minus $8,400 related to year 6, and $9,600 related to year 7. But we are in year 5. The company incorrectly recorded the total amount collected as rental revenue in year 5. What is the effect of this error on retained earnings in December in year 6? Alright, so related to year 6, $9,600. So we have not used the year 7 money. So I think this $9,600 over retained earnings is overstated by $9,600. Yeah. Because we're in year 6, the money that you report belongs to year 7. That's good. All right, everybody, it's time to take our first break. We will be back in 10 minutes. It's not 10 minutes anymore. So in about I would say in 9 minutes we'll be back so that we can continue. All right, so enjoy your break, and we'll be here in about 9 minutes.
Put some credential behind your name. Walk in that room and own the frame. This is your time, your season to grow. One step at a time, watch your future glow. Yes, you can do it, yes, you can. Rise from the doubt and make your stand. From high school diploma to EA, CPA, DBA, I see the fire, I hear you say, come study with me, come study with me. Come and study with me, come and study with me, come study with me. Put your name on top, put your name on top. This is your season, this is your season. Yeah, yeah, yeah. Library cards, fresh highlighters, head down focus, future fighters. One more chapter, one more try, one more test, one more why. From high school diploma to EA, CPA, DBA, that's the climb, that's the way. This is my goal. What is yours? Open that door, unlock more. Yes, you can do it, yes, you can. No more fear, just make the plan. Put some credential behind your name. Move with purpose, play that game. Come study with me, come study with me. Come and study with me, come and study with me. Come and study with me. Put your name on top, put your name on top. This is your season, this is your season. From the first page to the final light, I want your future to feel this bright. No wasted years, no empty pride, just a bigger life from the other side. Come study with me, come and study with me. Come and study with me, come study with me. Put your name on top, put your name on top. This is your season, this is your season. This is my goal, what is yours? Come build that dream and open doors. Come study with me. Come study with me. Come study with me. Come and study with me. Yeah, late nights, clean notes. I want the whole load. Gold pen on the page. Big dream, small cage. Put some credential behind your name. Walk in that room and own the frame. This is your time, your season to grow. One step at a time, watch your future glow. Yes, you can do it, yes, you can. Rise from the doubt and make your stand. From high school diploma to EA, CPA, DBA, I see the fire, I hear you say, come study with me, come study with me. Come and study with me, come and study with me, come and study with me. Put your name on top, put your name on top. This is your season, this is your season. Yeah. Library cards, fresh highlighters, head down focus, future fighters. One more chapter, one more try, one more test, one more why. From high school diploma to EA, CPA, DBA, that's the climb, that's the way. This is my goal, what is yours? Open that door, unlock more. Yes, you can do it, yes, you can. No more fear, just make the plan. Put some credential behind your name. Move with purpose, play that game. Come study with me, come study with me. Come and study with me, come and study with me. Come and study with me. Put your name on top, put your name on top. This is your season, this is your season. From the first page to the final light, I want your future to feel this bright. No wasted years, no empty pride, just a bigger life from the other side. Come study with me, come and study with me. Come and study with me, come and study with me. Put your name on top, put your name on top. This is your season, this is your season. This is my goal, what is yours? Come build that dream and open doors. Come study with me. Come study with me. Come study with me. Come and study with me. Yeah, late nights, clean notes. I want the whole load. Gold pen on the page. Big dream, small cage. Put some credential behind your name. Walk in that room and own the frame. This is your time, your season to grow. One step at a better time, watch your future glow. Yes, you can do it, yes, you can. Rise from the doubt and make your stand. From high school diploma to EA, CPA, DBA, I see the fire, I hear you say, come study with me, come study with me. Come and study with me, come and study with me, come study with me. Put your name on top, put your name on top. This is your season, this is your season. Yeah, yeah, yeah. Library cards, fresh highlighters, head down, focus, future fighters. One more chapter, one more try, one more test, one more why. From high school diploma to EA, CPA, DBA, that's the climb, that's the way. This is my goal, what is yours? Open that door, unlock more. Yes, you can do it, yes, you can. No more fear, just make the plan. Put some credential behind your name. Move with purpose, play that game. Come study with me, come study with me. Come and study with me, come and study with me, come and study with me. Put your name on top, put your name on top. This is your season, this is your season. From the first page to the final light, I want your future to feel this bright. No wasted years, no empty pride, just a bigger life on the other side. Come study with me, come and study with me, come and study with me, come study with me. Put your name on top, put your name on top. This is your season, this is your season. This is my goal, what is yours? Come build that dream and open doors. Come study with me. Come study with me. Come study with me. Come and study with me. Yeah, late nights, clean notes. I want the whole load. Gold pen on the page. Big dream, small cage. Put some credential behind your name. Walk in that room and own the frame. This is your time, your season to grow. One step at a time, watch your future glow. Yes, you can do it, yes, you can. Rise from the doubt and make your stand. From high school diploma to EA, CPA, DBA, I see the fire, I hear you say, come study with me, come study with me. Come and study with me, come and study with me, come study with me. Put your name on top, put your name on top. This is your season, this is your season. Yeah, yeah, yeah. Library cards, fresh highlighters, head down, focus, future fighters. One more chapter, one more try, one more test.
This is your season to grow. This is your season to start to study. Let's go ahead and do it. Break was good. Let's go ahead and lock in. And let's master something today. Alright? Put some credentials behind your name. Let's get it. description of the method used. Carried away method. Required disclosure for property, plant, and equipment. Notes to the financial statements. Notes to the financial statements. Required disclosure for property, plant, and equipment. Required disclosure. Disclosures for PPE. Method used in computing depreciation. Method. Methods used in computing depreciation. Depreciation. Method used in computing depreciation. Depreciation expense for the period. For the period. Accumulated depreciation by major classes. By major classes or in total. Or in total. Carried depreciation expense for the period, methods used in computing depreciation. Okay. The summary of significant accounting policies should disclose the what? Summary of significant accounting policies. Effect of retroactive application of an accounting change. Basis of profit recognition on long-term contract. Basis of accounting. Adequacy of pension plan assets in relation to vested benefits. Future minimum lease payments in the aggregate and for each of the 5 succeeding fiscal years. The summary of significant accounting policies should disclose the effect of the retroactive application of an accounting change. Basis of profit recognition on long-term contract. I'm gonna say this. Basis of profit recognition. On what basis you recognize the profit? Makes sense? One note that is always included in GAAP-based financial statement is the summary of significant accounting policies. This summary discusses the accounting principles selected and methods of applying those principles when more than one acceptable principle exists. Under GAAP, the note is included to assist users in properly understanding the information provided in a financial statement. Accounting principles provide guidance on the recording economic transactions and events. Right? The basis of profit recognition on long-term contract over time at a point in time is an accounting principle. How and when long-term contract revenue is recognized would be disclosed in the summary of significant accounting policies because more than one acceptable principle exists under GAAP. Basis of profit recognition on long-term contract. Which of the following is not required to be reported in a summary of significant accounting policies? Not required to be reported. Depreciation method. Basis of profit recognition long-term contract. Composition of sales by segment. You don't need to report. Okay. Criteria for classification of investment.
financial statement be accompanied by informative disclosures known as financial statement notes, which aid in interpreting and understanding the financial statement. One prominent financial statement note is the summary of significant accounting policies, which identifies choices made when more than one accounting method is permitted. Information underlying classification of accounts, investments, and tangible assets is also disclosed as part of the summary of significant accounting policies. That's good. Which of the following must be included in the company's summary of significant accounting policies in the notes of the financial statement? Which one should be included? Description of the current year equity transaction, summary of long-term debt outstanding, schedule of fixed assets, revenue recognition policies. There you go. Revenue recognition policies. How did you recognize revenue? Which method did you use? Which of the following information about the disclosed no, which of the following information should be disclosed in the summary of significant accounting policies? Should be disclosed. Refinancing of debt subsequent to the balance sheet date. Guarantee of indebtedness of others. Timing of revenue recognition from long-term contract. Adequacy of pension plans. Timing of revenue recognition. Revenue recognition, what method did you use to recognize this? Refinancing of debt. What method did you use to recognize? Yes. That works always. A company that wishes to disclose information in the financial statements about the effect of changing prices should be reported. A company that wishes to disclose information in the financial statements about the effect of changing prices should report this information in the body of the financial statement, in the notes of the financial statements. Company that wishes to disclose information in the financial statements about the effect of changing price, the notes. Supplementary information to the financial statement. Supplementary. The conceptual framework requires full disclosure of all useful information related to the financial statement. Information that is useful but not integral is supplementary information. Such information can relate to preparing the cash flow statement, direct method, deferred taxes, or other areas. It may be optional or required depending on the situation. Information regarding the effect of changing prices, current cost accounting, is optional and when presented disclosed as supplementary information. Although such information is helpful for users, it is not necessary to see this information to understand a company's financial position. So a company that wishes to disclose information in supplementary information. Okay. Effect of changing prices. Changing prices. Information regarding the effect of changing prices. Information regarding the effect of changing prices. The effect of changing prices. Carried cost accounting. Carried cost accounting. Carried cost accounting is optional. Is optional and when presented, disclosed as supplementary information. Presented, disclosed as supplementary information. Supplementary. disclosure of the fair values of the entity's financial statement, financial instruments is required when disclosure of the fair values of the entity's financial instruments is required when it is predictable to estimate those values. Aggregated fair values are material to the entity when it is predictable to estimate those values. Disclosure of fair values of the entity's financial instrument is required when it is predictable. Let's say both of them. I don't know. This is correct. When it is predictable. When it is predictable to estimate those values, and when aggregated fair values are material. Okay, material to the entity. Makes sense. Ownership interest is an entity against stock, cash, examine financial instrument. General disclosure, context to understand an instrument, objective for holding such instrument fair value. Okay. Financial instruments are monetary contracts between parties that can be created, traded, modified, and settled. GAAP defines financial instruments as cash, ownership, interest, stock, or contract that create both an obligation to transfer and a right to receive such instruments. Accounts receivable or payable, debt, securities, derivatives. Given the variety of financial instruments, many disclosures are required based on the specific type of instrument. However, each financial statement, whether recognized or unrecognized, must have context disclosed to understand the instrument, the objectives for holding the instrument, and the instrument's fair value when predictable to estimate. As with many aspects of accounting, such as disclosures are generally not required when amounts involved are immaterial. Things to remember: financial instruments, whether recognized or unrecognized, must have their fair values disclosed if predictable to estimate, presuming amounts involved are material. Right. So, whether recognized or recognized entity financial statement disclosure of fair values of the entity financial instrument required when, if it is predictable, practicable to estimate those values. If it is practicable, aggregated fair values are material to the entity. Must have their fair values disclosed if practicable to estimate. Practicable to estimate. Take some notes. Okay, things to remember. Financial instrument. Financial instruments. Must have their fair values disclosed. Fair value disclosed. have their fair values disclosed. If practicable, if practicable, if practicable, to estimate. Presuming amounts involved are material. Estimate. Presuming amounts involved are material. Amounts involved are material. Involved are material. As immaterial, you don't need to disclose it. These questions, they're of intelligence. It's almost 8. So now let's see what we can do. Alright, the following are just a few of the items that appeared on John Cole's books at the end of the year. Merchandise inventory $600,000. Loans to employees $20,000. What amount should Jones classify as monetary assets for the purpose of preparing carried cost accounting information? Carried cost. Loans to employees, merchandise inventory. What amount should Jones classify as monetary assets? An asset. Inventory is an asset. Loans to employees. If you loan money to your employees, is it an asset? If you loan money to your employees, is it an asset? If they will be paying you interest, is an investment. If it's an investment, it's an asset. It's gonna give you money. I'm gonna say this. 620. 620,000. No, 20,000. What? Carrying cost accounting is an optional approach in which companies supplement their financial statements with information on the effect of changing prices. This includes assets being reported as replacement cost rather than historical cost. Monetary items, example cash account, accounts receivable, debt, have a right obligation to deliver a fixed amount. For example, accounts payable are for a set dollar regardless of changes in the value of the currency or inflation before payment. Therefore, monetary items do not change value under current cost accounting. Non-monetary items are property, plant, and equipment, intangibles, or assets whose value may change. For example, inventory value can change based on multiple factors: inflation, resources, scarcity, customer demand. Therefore, monetary items report value as replacement cost under current cost accounting. Wow. Monetary items, cash can have a right obligation to deliver a fixed amount. Conversely, the dollar value of non-monetary items, property, plant, and equipment, inventory, intangibles, can change over time. Simple form inflation. So, what amount should Jones classify as monetary asset for the purpose of preparing current cost accounting information? Current cost accounting information. Good. Okay. Get it. We're gonna get it. So only the $20,000 inventory is not carrying cost. Okay. Monetary items, cash, receivable account, cash, accounts receivable, accounts payable, debt have a right obligation to deliver a fixed amount. Conversely, the dollar value of non-monetary items, property, plant, and equipment, inventory, intangibles, can change over time. So, what amount should Jones classify as monetary asset for the purpose of preparing current cost accounting information? Current cost accounting information. Take the notes. Current cost accounting information. Things to remember: monetary items, cash account, accounts receivable, accounts payable, debt have right. Okay, what amount should Jones classify as monetary asset for purpose of preparing current cost accounting information? Current cost accounting information. Current cost accounting information.
classified as monetary assets. Monetary items, cash accounts reserved, have right obligation. What amounts should judge classify as monetary assets? Monetary asset, non-monetary asset. Should judge classify as monetary assets. Cash accounts receivable. Accounts receivable. Cash accounts receivable. Accounts payable. Yeah, you can leave it as accounts payable. Debt. Have right. These have a right or obligation to deliver a fixed amount. Obligation. To deliver a fixed amount. Fixed amount. Non-monetary. Non-monetary. Property, plant, and equipment. Property, plant, and equipment. Inventory, intangibles. Inventory and intangibles. can change over time. So they are not current. They're not monetary assets. Monetary assets, you know what it is.
It's cash accounts, receivable accounts, payable, debt.
So if you loan money to your employees, this is monetary assets. But when you talk about merchandise inventory, this is non-monetary asset, and you recognize it right away.
Okay.
Non-monetary asset.
Okay. Property, plant, and equipment.
Non-monetary.
Okay, makes sense.
Which of the following should be disclosed in a summary of significant accounting policies? Management intention to maintain or vary the dividend payout ratio. Criteria for determining which investments are treated as cash equivalent. So what method are you going to use to determine that? Imposition of sales segment, calculation of depreciation expense, the criteria. When you see criteria, you see determining, you see designating. These are keywords for significant accounting policies. Which of the following information should be included in Millay Inc.'s Year 2 Summary of Significant Accounting Policies? Property, plant, and equipment depreciation is computed by the straight line method. During Year 2, the delay segment was sold at a significant loss. Reportable segment Year 2 sales are alley $1 million, $2 million. Future common share dividends are expected to approximate 60% of earnings. So,
advances to unconsolidated subsidiaries, allowance for credit losses, unamortized premium on bonds payable, accumulated depreciation of equipment, non-monetary, net monetary, gain or loss net. Which of the following account is classified as non-monetary? Advances to unconsolidated subsidiaries, allowance for credit loss, unamortized premium on bonds payable, accumulated depreciation of equipment. I'm gonna say the unamortized premium on bonds payable, allowance credit loss, allowance for credit loss, that's an allowance, advances, non-monetary, advances to unconsolidated subsidiaries. Advances, but there is an advance, allowance, unamortized premium on bonds payable. Gotta take one. Accumulated depreciation of equipment. Non-monetary, accumulated depreciation of equipment. An entity may elect to present the effect. Monetary items are fixed in amount and do not vary as a result of change in price. Accumulated depreciation of equipment, unamortized premium on bond payment, allowance for credit loss. Got it. Come back to this. 21. In supplementary information to its financial statements, DCCO adjusted its historical cost amounts by applying specific price indices to its depreciation expense and cost of goods sold. DC's adjusted information is prepared accounting to. See what that means. Fair value accounting. Supplementary information to its financial statements. Adjusted its historical cost amount by applying specific price indices to its depreciation expense and cost of goods sold. So adjusted information is prepared according to what? General purchasing power accounting, current purchasing power, current cost accounting. You said this adjusted information is prepared accounting. What the adjusted its historical cost amount by applying specific price indices to its depreciation expense and cost of goods sold. Alright, adjusted its historical cost account by applying specific price indices. Specific price indices, fair value accounting. General purchasing power, current purchasing power accounting, current cost accounting. Current cost accounting. Specific. Adjusted historical cost amount by applying specific price. Specific price. Current cost. Specific price. Fair value accounting, current cost accounting, optional reporting. Report item on fair value on financial statements. Disclosure approach failed to turn all the historical costs of default approach. GAAP requires allows some items to be reported under different methods. This occurs when decision usefulness of the financial statement would be negatively impacted without such alternate approaches. Fair value accounting is required for interpreting the financial statement that seems to be right, to correct if improper, to provide recognition of amounts not included in the totals of the financial statements, to present, I'm gonna say this, to provide disclosures that assist in understanding and interpreting financial statements. Correct. It's good. The notes. Okay. In a period of rising general price levels, Pollard Corp discloses income on a carried cost basis. Which of the following contributes to Pollard's purchasing power loss on monetary items? Purchasing power loss. Inflation. Refundable deposit. Inventories, warranty obligations, wages payable. Refundable deposits with suppliers. That could not affect. Which of the following contributes to Pollard purchasing power? Purchasing power loss. Purchasing power loss. Warranty obligations. Wages payable. Well, wages payable could reduce your purchasing power because you gotta pay wages. Warranty obligations. In a period of rising general price levels, Pollard Corp discloses income on a current cost basis. Which of the following contributes to Pollard's purchasing power loss on monetary items? Inventory is non-monetary item. Refundable deposit, warranty obligation, wages payable. I say wages payable because if you pay money, you have less to spend. No. Refundable deposit with suppliers. Is an optional approach by which companies, those subject to volatile price and significant inflation, supplement their financial statements with information on the impact of changing prices. The effect of such situation differ between monetary and non-monetary items. For monetary items, cash, account receivable. Alright. Wages, refundable deposits with suppliers.
All right, everybody. This has concluded our session for the day. It has been 2 deep focus hours. I have done so much in these 2 hours that I couldn't even do during the whole day. All right, so let's go ahead and keep going, keep pushing, never stop. All right, keep going. Because sometimes you will feel discouraged, right? Sometimes you're gonna feel that you're discouraged. Sometimes you're gonna feel that you can't do it anymore. Sometimes you're gonna feel tired. But in these moments that you feel tired are the moments you need to keep pushing. Do not give up. If you need to take a break, take a break. But do not give up on your goals and your dreams. Because if you do it, time will go by. If you don't do it, time will go by anyway. So why not do it now? You understand? So let's keep going. Let's keep pushing. Because hard work will pay off. It'll pay off, my friend. All right? So thank you very much for sticking around with me. And it has been an amazing 2 hours of study, deep focus studying. Let's go. Let's do it. I'll see you tomorrow in the morning, 7 o'clock. Have a great night.
Come study with me. Come study with me. Come and study with me. Yeah, late nights, clean notes. I want the whole lot. Gold pen on the page. Big dream, small cage. Put some credential behind your name. Walk in that room and own the frame. This is your time, your season to grow. One step at a time, watch your future glow. Yes, you can do it, yes, you can.